we're looking at one of the biggest stories in healthcare, a category killer during the next 5 to 10 years.
What do your analysts think Teladoc is worth per share?
Teladoc is thinking big. You ask us, what is our price target out there? Well, a tenfold increase. This is like Amazon. We see Teladoc in the same league as an Amazon.
I think we need to start holding investors on mainstream media and right here on YouTube more accountable. So I rounded up a few very recent interviews with Cathie Wood, as well as Simon Barnett, ARK Invest's analyst that covers Teladoc. The goal of this episode is to put ARK Invest's latest comments on Teladoc all in one place, so we can look back on it in a few years and see how it played out. Full disclosure, I have a pretty big long position in Teladoc, as well as ARK Invest's funds. And on ARK Invest's side, Teladoc was their second biggest position overall, right behind Tesla. Today, it's their 7th biggest position, but that's only because the price collapsed by almost 50% last week. ARK Invest has been buying a lot more Teladoc stock since that happened. So with all that context, let's hear what Cathie Wood has to say about Teladoc. Does she really think it's like another Amazon stock? Let's take a look.
To be clear, you're saying that at $35 today, your analysts think Teladoc is worth $350 a share potentially. So when you say there's a 5-year time horizon, those are the kinds of values that you're pitching to the investors who are kind of sticking around to still see this story out. Teladoc bought Livongo for $18.5 billion and just took a $6.5 billion goodwill write-down. So why should we trust Teladoc's business model and some of the choices that they've made? And what does ARKK think this stock intrinsic value is?
So Livongo was a we don't like growth by acquisition generally, but Livongo was a very important piece of the puzzle. This is a data story, as all artificial intelligence winner take most opportunities are. And we have 2 data science organizations coming together, Teladoc and Livongo. Teladoc is thinking big. You ask us, what is our price target out there? Well, as Simon Barnett, who is one of the most brilliant analysts out there in this space, as he was looking at his model and looking at how far ahead they are on the enterprise side, far ahead relative to our expectations. And remember, enterprise B2B is where we think this story is going to fly. He was adjusting his model and he said, I can't even throw out this number. We'll haircut it by 50%. But he sees, again, preliminary estimates, a tenfold increase. This is like Amazon. Remember, Amazon in the day, it IPO'd at 18 in 1997, went to 118, and then in the crisis, round trip back to 18. Today it's at 2,500. We see Teladoc in the same league as an Amazon. This is a winner take most market, and we feel that yes, short term there was an earnings shortfall. They had to cut estimates. Admit that. We're looking 5 years out. We're looking at one of the biggest stories in healthcare, a category killer during the next 5 to 10 years.
So this is the heart of the investment thesis for Teladoc. This is a data story. Livongo and Teladoc are both data science organizations that are coming together and using big data to provide a total healthcare ecosystem. Simon Barnett is the ARK Invest analyst covering this stock, and I've actually had the privilege of interviewing him right on this channel. Simon is really great at connecting the science behind the stock back to what it means for the business in the present and its growth in the future. Now we know that it's Simon's model that makes ARK Invest so bullish on the company. One complaint that I have, not only as an ARK Invest shareholder, but as someone who reads all of their research, is that they don't make all of their models public. Every year, they release an update on their Tesla valuation model and do a deep dive article into all the different assumptions they're making about all the aspects of Tesla's business. Teladoc was ARK Invest's second biggest position overall, and ARK Invest is holding over 10% of all of Teladoc's shares as a company. So why don't we have their valuation model? We do have the next best thing though. Late last night, Simon had an interview on TD Ameritrade, where he talked in detail about their bull case for Teladoc. But since it's not Tesla or Palantir, nobody watched it. So let's watch the interview together. I'll be taking notes and I'll share my thoughts with you at the end.
Welcome back to Market on Close. Everyone's hopes are high in the bullish camp for a peaceful conversation with the Fed chair tomorrow. Maybe no shock surprise could unleash the rebound many are waiting for in growth themes that oftentimes get embodied by the ARK team's picks. As we've been following the last year, the ARKK fund has unwound its big gain back to pre-COVID highs. Teladoc, the latest one that hurt. Let's bring in the team and talk about it now. Joining us, Simon Barnett, analyst at ARK Invest. Simon, thanks so much for being on the show this afternoon. Welcome. As we saw this big sell-off in Teladoc, we then saw the follow-on stories that your team at ARK is doubling down, buying more of the stock. Walk us through the thesis here, the latest update.
Sure. So maybe it's good to start with talking a little bit about our research perspective. You know, we're long-term investors, and typically when we underwrite positions, it's at a minimum of a 5-year time horizon. So I think it's a good reminder for people to consider that back before the pandemic, when Teladoc was at this price level, the company had 1/6 of the visit volume, 50% of the paid members it has now, 1/5 the annual revenue, and was also cash flow negative. So if you flash forward to today, roughly 1 in 6 Americans is a full Teladoc member, and the company is cash flow positive. So if I were to focus in on the quarter, and I think what explains the reaction from the stock price, I think the main thing to focus on is the roughly 25% or so reduction in EBITDA guidance for 2022. And this was mostly caused by a decrease in marketing yield and, the concomitant increase in customer acquisition cost, particularly within the direct-to-consumer mental health channel. And as a reminder, and we'll touch on, our long-term investment case for Teladoc is much more B2B and less direct-to-consumer. And maybe one more thing to keep in mind on EBITDA. Since the beginning of the pandemic, the company's EBITDA has grown 650% in real dollar terms and doubled as a percentage of revenue. This is adding to its roughly $900 million cash position, which we view as an extreme asset, considering the route on less profitable names. And as the market adjusts, we think having that position of strength to be experimental, to take risks in new customer acquisition strategies is really going to be a key asset for the company. And I'll pause there, but I'm also happy to kind of dive a little bit deeper into how we see the transition to B2B.
I really want to hear that. I want to go just quickly to some of the numbers that you gave there, because, there's a lot of companies here that are showing weak cash flow in the market, getting punished, or really no profitability hopes. It doesn't seem like Teladoc's in that camp, especially.
Yeah, that's a really good call out, actually. As interest rates continue to rise, it's really important that Teladoc has this healthy cash position so that they're not taking higher and higher interest loans and paying a lot more money to fuel their own growth. So I really like that call out, especially with the Fed meeting happening pretty much right now, that Teladoc is a little bit separate from these other growth companies in the sense that they can fuel their own growth because they have such a big cash position today.
With the cash flow positivity. But I do wonder about the integration of Livongo, a business that they spent, $13 billion on almost, and at like a 50 times revenue. So how do we know when that's worked through the system? Was it too much for them to bite off and chew? Is it too early of a business to figure out how that's going to work? What's the math on when that's kind of been absorbed? Because it doesn't happen overnight. Is that maybe one explanation for what's been happening to the stock price over this time?
Yeah, no, I think it's a great observation. So when it comes to acquisitions, it's important to remember that Teladoc has been acquiring, I think they've now acquired more than a dozen businesses over the decade or so previously, and they've successfully integrated all of them. Now, to your point, Livongo was certainly the largest, any way that you want to cut that. And I just want to, remind people, because this happened, I believe, back in August of 2020, that deal was done with both cash and stock. So while Livongo's, price to sale multiple, or whatever multiple you want to use, was definitely inflated at that time, so was Teladoc. So that's one thing I want to keep in mind.
So that's a really great point, and we walked through that ourselves in my previous Teladoc video, where we saw that Teladoc acquired Livongo for anywhere between 40 to 75% over their market value. And just for reference, Elon Musk just acquired Twitter for about 40% over its market value. So that's really not that crazy for an acquisition of that size.
Now, when it comes to evidence that the integration is going well and progressing as we would expect, I think there are a couple ways to look at it. So the first thing I think top of everyone's mind is labor dynamics and talent right now, and especially within the way that we've always looked at Livongo was much more for their data assets and their AI. So since the acquisition was announced, the company has tripled its headcount in terms of data science and R&D. They've put cash there as well. They got the former CTO of Memorial Sloan Kettering. His name is Klaus Jensen, is now heading up the strategy there on R&D. And they also pulled in, actually just last week, someone named Dr. Vijaya Ramantangela, who was the GM of life sciences at Amazon, which people, Amazon Web Services specifically, which people, bring up a lot in the context of competition. And so one of the ways that we think about the evolution of the company from something that was a lot more, a few years ago, like kind of point care, sort of general medical telemedicine, to something that's much more like an enterprise partnership solution. One of the ways that we want to see that is the continued integration and launch of new products that include everything from acute care to chronic care management, behavioral health and mental health, and also spanning care settings, right? So virtual care when it's needed, as well as working within the context of health systems, right? The physical brick and mortar locations.
One great example of this is instead of competing with Teladoc, Amazon just decided to integrate with them. So right now, Teladoc is something that you can interact with through Amazon's Alexa. Even a business as big as Amazon is shifting from competing with Teladoc to deciding to integrate with them.
In fact, just last week, Livongo won the largest health system in the state of New York, Northwell. They displaced an incumbent competitor there because of the fact that some of their new offerings like Primary 360 and Chronic Care Complete are much more comprehensive, right? Whole person solutions that don't look at something like mental health in a vacuum, right? Understanding how a chronic condition can affect your day-to-day well-being is extremely important. So to kind of seal that off, I think the next phase of tracking Teladoc's growth is going to be kind of looking at those competitive wins, the launch of new products, and a few quantitatives. And I think, some of those to maybe mention are like increase in utilization. So that's up about 160% since the beginning of the pandemic.
Right.
The number of new launches that are multi-product, meaning they're not just using one legacy Teladoc product, but multiple services.
How does that change post-COVID? Simon, any idea if those numbers can keep up when COVID is retreating the way it is?
Yeah, it's a great question. So I'll start with the numbers. Before the pandemic, that number was roughly 67% of new signs were multi-product. It's now up to almost 80%. So it's certainly tracking in the right direction. The percentage of Teladoc's visits that are due to something like infectious disease is actually lower on a percentage basis than it was before the pandemic. So it's not as if these, infectious disease visits are kind of gassing the numbers. And absolutely, we want to be totally sensitive to people who are aware that the digital health market is in a complete whipsaw right now and has certainly surged up and peaked and has kind of stabilized now down to a level that's about 40x higher than it was in 2018. So there's a lot of room and runway to go with this. And I think certainly from the conversations we've been having with health plans, self-insured employers, all of them are kind of interested in having a much more whole person holistic offering rather than trying to cobble together, smaller point solutions that are more difficult to maintain and certainly harder to optimize around something specific like return on investment or, specific healthcare benefits that may be relevant to a population.
Hey, Simon, we're out of time, but this is really helpful and for us thinking about it going forward. The one other thing I'm curious about, is there a way to measure what percent of hospital or doctor-patient interaction can happen in a virtual world? Is it possible the market overestimated what is going to be taking place virtually? When I tried to set up an appointment with my doctor and found out they were only doing virtual, I picked a different one. I've been in a new one because I just, other than maybe mental health or things like dermatology that you can see, how much really can we do? And is there a way to gauge maybe customer satisfaction down the road here or kind of post-COVID on whether or not people feel like they're getting a bang for their buck?
That's a great question.
Yeah, on satisfaction, I would look to kind of standard industry benchmarks like Net Promoter Score is probably a good one for that. But to your point, I think, and I certainly agree. I mean, I've been in the same position about wrestling with doing something in person versus virtually.
Yeah.
But it's a really important distinction I want to make here is that Teladoc is not just a telemedicine sort of virtual care, veneer that just connects doctors and patients. Yes, that was kind of the legacy component and absolutely is a core part of the system. But really, it's about integrating more deeply within the physical care side, sometimes in ways where you don't even realize it. A really good example would be, the fifth largest commercial insurer in the US, HCSC, is now working with Teladoc to launch this solution, for its beneficiaries. But it's almost like a white label service where you don't even realize that Teladoc is the underlying utility. It's the infrastructure that enables that to happen, right? So it's not just about, who you're using on the front end to talk to a doctor, but great question.
Interesting. Okay. All right, Simon, thanks for the explanation here. Looking forward to continuing the discussion. Appreciate it.
So one thing I really like about this interview is that it goes into the nitty-gritty details of ARK Invest's thesis. Even though Teladoc stock has collapsed by around 90% from its peak, Teladoc, the company, has grown like crazy. 6 times the visit volume, double the paid members, 5 times the annual revenue, and 7 times the EBITDA. Importantly, this growth isn't just from the pandemic, or else these numbers would all be coming up from a huge spike in Teladoc's infectious disease cases. But that's not what happened. Not only that, but the market seems to have the wrong take on Teladoc. It's not Zoom for doctors. It's becoming the enterprise partnership solution that's spanning all areas of health and multiple healthcare settings, virtual and physical. One thing we should keep watching for on that front is the continual launch of new products and integrated services, which are the kinds that point solutions simply can't provide. Why is that important? Because in the business-to-business world, companies don't want to deal with 10 or 20 different healthcare partners any more than they want to deal with 10 or 20 HR service companies or payment solutions. Teladoc is putting itself in the differentiated position of being a one-stop shop for B2B enterprise solutions for healthcare. I really think that they nailed the point home with the last question. Did the market overestimate the demand for virtual care back when the pandemic started? Simon says it's not just about virtual care. It's about being able to integrate more deeply with physical doctors and hospitals to replace a lot of the manual, paper-driven business that's being done there today. Teladoc is becoming the digital infrastructure that allows doctors, insurers, hospitals, and patients to connect. That's the 5 to 10 year thesis on Teladoc, and why ARK Invest thinks this could be as big as Amazon stock over the next decade. After seeing these interviews, I won't be selling any of my Teladoc shares. It's up to you to decide what you want to do, but at least now you have all the right information all in one place, so you can look back and hold ARK Invest accountable. And you can hold me accountable too. Simon, if you're watching this, I'd be happy to have you back on the channel for another deep dive into Teladoc, Exact Sciences, and the vision behind ARK Invest's genomic strategy. Thanks for all your great work, and if you want to check out my previous interview with Simon, check out this episode next. And if you feel I've earned it, hit those like and subscribe buttons to let me know that you enjoyed seeing the science behind this stock. Thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.